Hello and welcome to the Global View. On this Thursday, let's take a look at what's going on at a macro level globally. A broad sell-off in government bonds across the globe drove up US 30-year Treasury yields to 5% for the first time since 2007. The rout in bonds is leading to speculation that it could hasten a global slowdown and hurt stocks and corporate bonds. Australian 10-year bond yields have surged more than 20 basis points this week, with similar moves for the US 10-year yield, which has pushed above 4.8% to be up around 100 basis points this year. Two-year yields, they were last at 5.05%. However, the latest US economic data provided some relief for investors, with private payrolls increasing far less than expected in September. The ADP National Employment Report showed at 89,000 jobs created last month, well below the 153,000 jobs forecast by economists. In other data, new orders for US made goods increased more than expected in August. Well, the US dollar index eased as Treasury yields retreated late in the session. The Aussie dollar trading higher at 63.3 US cents. Well, to get across what's going on at a macro level and how that's likely to influence our investment decisions, particularly given what's happening with those Treasury yields, I caught up with Gary Evans from BCA Research.
Yeah, it was an incredibly volatile day on Wednesday. I mean, we started the day pretty much at 4.9 and we closed the day at a little bit more than 4.7. So I think what has been happening is that the market took a long while to price in higher for longer. 6 months ago, the market thought the Fed was going to be cutting rates by Q4. We'll cut 200 basis points in the first half of next year. Now it's taken that out. We've also got some worries about the amount of issuance that's coming out. And if you're a Japanese investor, Japanese bond yields start to look quite attractive after you've hedged your FX costs. So all that's created a bit of momentum. My view, however, would be we're probably pretty close to the end of this. And at sort of 4.7, 4.8 on the US 10-year and the equivalent in Australia and other countries, you've got some pretty interesting carry now coming out of bonds. And with the risk of recession on the horizon, you're going to see you would see those interest rates fall, and that's going to give you pretty nice upside as well.
Although, of course, we look at the effects of those higher borrowing costs with, of course, acceptance now essentially that those interest rates will remain higher for longer. What's the impact on, well, certainly the consumer, on businesses and the broader economy?
Yeah, so I mean, ultimately, the cure for high rates is high rates. There's a phrase that the cure for high oil prices is higher oil prices. With rates where they are now, we're going to start to see significant pressure on corporates, households, etc. In the US, 30-year mortgage rates are now close to 7.5%. Now, the problem is that unlike Australia, where you mostly have floating rate mortgages, in the US, people have mostly 30-year fixed. So it takes a while for that to come through. The same thing is true for corporates. Most even high yield bonds are for 4 or 5 years. So it'll take a year or two before that comes through. But we're starting to see the effects already. The number of defaults has started to rise. There's some parts of the economy look particularly vulnerable. Commercial real estate, vacancy rates have picked up. We're not working in city centre offices anymore. The cost of funding buildings, and most of those purchases are done on a very leveraged basis. Those costs have gone up. So eventually, with rates at this sort of level, in our view, that's going to trigger a recession. The problem, however, as Milton Friedman famously said, is that monetary policy works only with a long and varied lag. We don't know exactly when that recession is going to happen. On average, between the first Fed rate hike and recession, took 2.5 years. The Fed raised rates in March last year for the first time. So it may well not be until mid next year before we have enough of these cumulative effects for it actually to push the economy into a full recession.
All right, so what does the investor need to consider when you're looking at your portfolio, Gary? What should you be doing right now? Let's first concentrate on equities.
Yeah. So it depends a bit on your time horizon. If you are a trader, you're looking at the next quarter, the next month. We've had a pretty solid sell-off in equities, and I wouldn't be surprised from these sort of levels to have a bit of a rebound. On the 12-month time horizon, though, I think that would include the recession. And typically, you see stocks peak a couple of months before the recession begins. So if you're a conservative investor, getting that timing, as I said, right is very difficult. So I would be pretty defensive in my equity portfolio. If you want to to ride the next leg up, if you want a call option, if you like, to me, the cheapest way actually to do that is through Australian equities, through the materials sector. It's a very cheap sector. Analysts are forecasting something like a 20% decline in earnings. But if we were to see a little bit more of incremental stimulus coming out of China, and China's always the key here, China buys about 50 to 60% of all global metals, iron ore, copper. Just a little bit of extra stimulus out of China, I think, could cause metals prices to pick up. So that, to me, is perhaps if you want to ride up just the trading next quarter or two, that might be the way to play it. But if you're thinking 12 months, want to reduce the weighting of equities in your portfolio, we just went overweight on the utilities sector, which is obviously super defensive. It does well when yields come down, when interest rates come down. And, as you go towards recession, that's what you'd expect to see. The Fed's starting to look to cut rates, 10-year bond yields will come off, and utilities would be a big beneficiary from that move.
Okay, so overweight utilities. What are you doing with tech then? Obviously, given those very impressive gains we saw, particularly in the first half of the calendar year.
Yeah, so we just cut our weighting in tech we've been overweight for 18 months or so. It is getting expensive. Higher rates are a bit of an issue there, but I think the bigger issue, frankly, is earnings. Analysts have got something like 15% growth in IT sector earnings globally over the next 12 months. Our models are pointing to close to flat. If you look at someone like NVIDIA, for example, it must be a huge story this year. They've been hugely surprising on the upside. They'll announce their next earnings outlook in mid-November. Given how high expectations are and how expensive that stock is, can they really push any further from that? If you look at someone like Apple, for example, they are also close to 30 times earnings. Great company, but it doesn't take much in the way of bad news, as we saw, for example, in China earlier this month or last month, when the Chinese government banned civil servants from owning iPhones in practice. So ultimately, what it comes down to is when equities start to sell off, and I think that will happen in the next 6 to 12 months, investors sell what they own. And what do they own? They own those big seven, the magnificent seven tech stocks: Apple, Google, Tesla, NVIDIA, etc. And they, to me, look quite vulnerable in the event of that sell-off.
What's your view on energy, Gary? Of course, we did see the oil price. It came off about 5% overnight our time. Nonetheless, though, of course, we have seen those production cuts by OPEC Plus producers into the end of the year. So what's your outlook?
Yeah, so we think the energy price can rise further. I mean, the last day or two, I think natural correction, people taking profits, it's run up a lot from 70 over the last few months. What's driving the oil price is, you mentioned, the supply cuts. Russia and Saudi Arabia seem to be pretty disciplined on that. And although the Chinese recovery from COVID has been a bit disappointing, the one place where they have been using more is energy products. You're starting to see Chinese tourists go overseas again, flying on airplanes. Chinese are driving around. And therefore, China's oil demand has been very strong this year. So even in a world where the rest of the developed economies are seeing relatively weak demand for oil, the supply side constraints in China say to us there's more upside. And we think even Brent, which is currently a bit under 86 today, we're looking for that to go maybe as high as 120 by the end of next year.
Okay, Gary, so that's the view on equities. What's your position, your portfolio position in fixed income?
So we recently went double overweight on duration. So that means that we basically think that bond yields will come down. Ultimately, what it comes down to is recession. If you look at the average recession, US 10-year bond yields have fallen about 2.6 percentage points. So that would take them back to around 2%. On the upside, we've never really in the last 40 years had 10-year bond yields go above the Fed fund rate in an environment of rising rates. So, that puts an absolute ceiling at about 5.3% in our view. So if we were to see 10-year rise to 5.3, you're still actually going to make a little bit of money because you've got so much carry in treasuries. If the yield in the recession goes down to 2%, you're going to make about 25% upside. So it seems to us a very asymmetrical position. If, as we believe, you'll have a recession, the government bonds everywhere around the world are a good hedge. And they're a cheap hedge because, in what we would see as the worst environment, you're not actually going to lose money by holding that hedge. So getting the timing again right is difficult. I think we probably need to see the first signs of recession, unemployment starting to rise, and that's not happening yet. But over the next 12 months, I would have a very high conviction view that bond yields will be significantly lower in October next year than they are today.
And just in terms of the alternative space, private credit, you're seeing that being very attractive at the moment.
Yeah, and obviously you need to look on a very different time frame there. So, you can't put your money into hedge funds or private equity, private credit, and take it out 6 months' time. So you're looking to commit for 5 years. So getting into private credit at a point where the economy is weak, where lenders are in a very strong position, they can demand from borrowers anything they want, tough covenants, tough terms, etc. And where you're getting now yields in that market of sort of 11, 12% in terms of direct lending private credit. So to put your marginal dollar into that area makes most sense to us. And if you wanted one particular area, it would be distressed debt. We're starting to see defaults picking up. For a skilled distressed debt fund manager, this is exactly the time when they can go in, buy credits, 20, 30 cents on the dollar, can work those through and come out with a lot of money. So allocating money to distressed debt in the middle of recession, paradoxically, is the right time to do it. People who did that in 2008, 2009, made a lot of money. We're probably not quite there yet, but if you are allocating money, looking for those distressed debt funds now, giving them the ability to put that money to work over the next 6 to 12 months makes a lot of sense to us.
Gary Evans from BCA Research. All right, let's catch up with some international news. US quarterly reporting season begins this time next week. ExxonMobil is saying it expects third quarter oil earnings to grow. It's saying changes in oil price will lift its upstream earnings by $900 million to $1.3 billion US compared with the second quarter. Exxon having posted $4.6 billion in upstream earnings in the second quarter. And Clorox is expected to post a loss in the first quarter after a cybersecurity attack in August caused product outages, processing delays and wide-scale disruption to its operations. All right, just to check the market before we go, SPY futures indicating we are going to have a positive session, which is a bit of a break we see from the heavy selling we've seen over the past couple of sessions. SPY futures up 0.4%. Stay with us. The open is just around the corner.